All right, so now we're going to move on to William. And William asks the question, good afternoon, Michael. Is your 2-week bull put credit spread strategy shown on the 14-day free trial? If not, could you review the parameters that you use? Furthermore, if one wanted to trade 3 to 6 day out bull put credit spreads, would I use the same parameters as the 2-week strategy, just changing the time frame? The answer is yes, it is shown on the 14-day free trial, William. Yes, I will review the parameters, of course. And if you wanted to extend it, would you use the same criteria? Potentially, but you can have a little bit more leeway with some of those parameters when you're going 3 to 6 weeks out. But in the recent market conditions over the last 2 years, those month out, 6-week out bull put credit spreads got a little hairy from time to time. I still track some of them, not trade them. I still track some of them. Okay, bull put credit spread, what we're coming out with soon, the bull put credit spread product, the trading approach that we use for bull put credit spreads, where we look for bull puts that are 2 weeks out in time. Okay, 14 days out in time, but usually I open these on Monday. So technically, if I'm opening a bull put from this screen, we're looking at 11 days out in time. And we'll go through a full Friday, one full weekend, and the next week as well. So here's the search results. Weekly bull puts is the default screen. And over here on the right, William, are the criteria that we're using. As I mentioned, due to our testing and what we've done in our own accounts, we've found, and this was, we've been doing this testing and trading and analyzing and back testing and trading and back testing alternatives against what we found really worked since about 2016 or so, roughly. Really wanted to get it nailed down, 2017. Okay. What we found is that actually, over time, different market conditions, the 2-week out spreads perform better annually than the 1-week out positions. Part of the reason why is that if you're looking for a good probability of 75, 80, 85% on a 1-week out spread, for a 2-point spread, you're looking at maybe 9 to 10 cents. Okay, that doesn't sound too bad, because if I go 2 weeks out, I might only be making 16 cents, 20 cents. But if there's a sudden move during that week and it blows below both strike prices, it can happen with the 2 weeks as well. But if I only took in 9 cents and I lose $2, it goes below both strike prices, and I'm near the full loss of $2 or $1.91, what did I just do? I just wiped out 20 previous trades. If I'm only opening 3 or 4 every week, that's going to take me 5 full weeks to get back to break even. But if I'm taking in, let's find to see if we have a 2-point spread. There we go. If I'm taking in 35 cents, 36 cents, 25 cents on a 2-point spread, and it goes below both of them, that's only 4 trades. I'm sorry, that's, that's 8 trades. Okay, it's half the number of trades I need to be successful to get back to break even. We would see in the testing that the 1-week out trades would fall very far behind and it would take longer to get back up. Now you're trading every week, so yeah, it takes me less time to get to 20 trades, but then you hit another slump and you're back down again. And now you need more trades, more weeks to get back up to break even. It was kind of challenging to do, and that's what we saw through multiple years, through 2017, 2018, 2019, even into 2020. Okay, so that's the first criteria. Yeah, we want to look for a good return. In fact, I actually want to target closer to more of a 12 or 15% return, but I'm looking for a minimum of 9. And I want to be that 85% probability or higher. We've just seen that that looks to be the safe zone. That looks to be the quality. So sure, I can have a great run of looking for bull put spreads that have that 70% probability. The short put only has a 30 delta. Here it's about 0.15, so I'm getting a higher premium. But long term, it does not perform as well. You could have small sections of a very bullish run where you have a very high return, easing off the probability, looking for a lower probability. But this is designed to, if you come to Power Options, you go to our default searches, you pull up a default search. Why we have them there and why we test those and why we put those criteria in is that if you do this long term, you can expect to potentially have good results. Of course, there's other factors involved, which is why we have a whole product that's coming out, William, describing the approach that you would use with this. Okay, and of course, the strike difference we found, the 1-point strike differences were almost like using the weeklies. Even if you were out a month, William, or even if you were out 2 weeks or 3 weeks, the 1-point spreads, even though they require lower margin, tend to hit the maximum losses faster. Because in the occasions when it dropped below both strike prices, where in other positions, a 2, 2.5, or 5-point spread, I might only be at a 30, 40, or 50% loss instead of near 100% loss as well. The technicals shown right here, hey, we're looking for stocks in an uptrend. We want to see a good positive MACD cross as well. Of course, the fundamentals, not looking for things I'd normally look for. Good market cap, positive earnings per share growth. We are avoiding stocks between now and expiration. I'm sorry, stocks that have earnings between now and expiration as well. In that case. And so these are the trades that match it, and the criteria is shown as well. So that's, you can see the active filters are being used right here. We reviewed some of those, most of those as well. And then there's other caveats involved as to the timing of the trades, what to look for as well. In that case also. So here are the results of the trades. Today is the 20th. Wow. Sorry, that's just, forgive me. I forgot what day it was, to tell you the truth. I almost said the 27th. I'm a week ahead of myself here. I don't know if I want to be through Thanksgiving or if I'm just thinking it's towards the end of the month already. In any case, it's just expiration. Another 10 days to go to the end of November. The top 3 positions that matched the bull put credit spread search. All the ones from October 26th to the 2-week out expiration expired worthless. I'm sorry, the other 3 here, I already expired the one of them. I think it was on no, it wasn't Wynn Resorts. It was the other, AMAT? We'll check in a second. But both of these expired worthless as well. Okay, the Wynn position and the Facebook position around a 17% return, and the AMAT position was, just take a look. ANET, A-N-E-T, I'm sorry, was one of the top 3 that matched the criteria. This is not a 30% return. This was a 13.6 return on the 2.5-point spread. The $1.20, no, it wasn't a $1.20 credit. I apologize. It was for 4 contracts. So it was a 30-cent net credit against the 2.5-point spread. It was a 13.6% return. And here's some of the, those are the 2 that are open that I haven't expired. Here's the ones, yes, that expired November 6th expiration. So these ones here that expired today were naturally opened on November 9th. All 3 of those expired worthless as well. Interesting enough, let's just take a look, of course. And we'll go to back test under bull put credit, Smart History Excel. And I said the 9th. I'm sorry, yeah. So the November 6th, October 26th to November 6th, that was one cycle. Now November 9th, weekly bull puts. So what were the 10, 15 trades that would have matched the bull put credit spread there as well? And William, I'll get to the third part of your question in just one moment. Okay, so it says 15 of 19, but we're only showing one result. So there might have been 2 Facebooks, 2 Wins, 2 Amgens, and so forth. But I'm going to calculate the group results. There we go. Wow, that was fast. I don't think I've ever seen it that fast. It's 5:22, so maybe the history is done. But most of you know that when I run the history, when we try to do a back test with the history tools at 4:45, 5, or 5:15, it sits there for a minute or 2 because we're actually loading the huge amount of data from today's close. In any case, there we go. Of the top 12 positions there, 8 positions that weren't repeats, all 8 expired worthless, would have been 100% return. 13.3% average below the level. So that's why I usually look at just the top 3 or the top 4, because I want to average around a 14.5 to 15% return with the 3 or 4 positions I'm opening in that cycle as well. Okay, so let's go back real quick before I get to Chuck's question. All right, clear the things. Now, third part of William's question was, I want to go out in time. I want to go 3 to 6 weeks, for longer and higher return. Do I keep the same settings? Initial thought is, why not? Okay, so instead of going 21 to 30 days out in time, or I know 6 weeks would put us at about 40 days out in time, include all the weekly. Let's just go December to 28 days. Leave everything else the same way it is, William. We're going to see some similar trades, of course. We're going to see some similar stocks. We're probably going to see higher percentage returns. Yep, 23, 19, 14, and so forth on these positions. Probabilities there. One thing I should add, and I really want to add for this example, We're going to go into see more or less columns feature there. Any of the filters I can use on any search. We looked at the naked put search earlier. We're in the bull put search now, but if you're doing long calls, if you're doing iron condors, any filter you can screen by, you can choose to see that column in the results. So we want to see the out of the money range. We could look at the short option delta as well. I'll throw that in there just for the discussion. Okay, go ahead and close that. Oh, be nice. There we go. So we're going to end up with the same results, but all I did here was add 2 extra columns once it comes up. We're going to have the percent out of the money range, 12.3% out of the money, and we've got the short option deltas as looking for that probability we wanted of 80, 85%. We're at 10, we're at 11. Some of these are 20% out of the money or more. Why am I bringing this up, William? These are all still good returns. It's still in the wheelhouse of what we look for. For a 2-week out spread, right? Here we're going 4 weeks out, so we're not doubling the return. So if you're comfortable thinking that the stock might not drop more than 10% in the next 30 days unless something drastic comes out, which is always a risk with these leveraged spreads. Remember, you can lose 100% of what you invest in a bull put credit spread. You can take 100% loss if a bad market turn happens. That's why there's rules to when you should be trading or should not. But what we're going to do here is we're going to change it. I'm actually just going to take out the probability, William. We're just going to go 10% out of the money instead for the 30-day trade. We're still going to see probabilities in the 75, 78, 72% range very easily. But instead of going further out of the money for the 8, whoa, okay, so that's way too many. We're definitely going to put this up. Let's double this, William. Let's double that to 18. That's going to be pretty simple to do. And remember, of course, on a standard expiration, you're always going to see more results in that case. 76 results here. 10, 11, 16% out of the money. Ignore these two. Okay, and you see, yeah, these have a very, very high percent return for the 2 and 2.5 point spreads. More than double of what we expected originally. But again, if you feel the stock might not drop more than 10% out of the money, in that case, you're seeing positions here where the delta is near 0.3 now instead of 0.10. Not as far out of the money. Don't have as much. Where's our probabilities? Oh, the probability, okay, that's not good. The probability needs to be at least 70 or 75. You would never, that's why it's so high. You'd never trade a 58% probability bull put spread. You might do that with a bull call debit, William. It's safer than the bull put credit spread to do it in that case. Let's just put the probability back to where we want, 75, not 85. I'm going to give it maybe even 73. Let's pull it back into where we'd still want to be, even going out 30 days. We're going to lower the probability, keep a 10% range out of the money or more. That's what I expected to see originally. 30% returns, 31% returns, 28% returns, and more. Same similar filters, just doing it this way, going further days out in time. Let's just save it. Bull put 1 month out, weekly filters. Now, you might consider this unfair. Why am I saving this? Because we're going to do the same thing we just did with the weeklies. I just showed you the top 3 positions that would have matched the weekly screen. Okay. I apologize, that matched the weekly screen there would have all expired worthless. I could have gone back the other time from October 26th, November 6th, all of them expired worthless. From November 9th, the following Monday, to today's expiration, we saw all 8 of those that would have matched on Monday expired worthless. And the 3 positions that we had in the portfolio expired, the Win one, the Facebook one, and the Anet one as well. Well, I got to remember something. This is a month out spread. We want to see how it performs. So let's go ahead and go out. Oh, what am I doing? Sorry. Let's go to September. And I think that's it. Yeah. September 21st would have been the Monday following expiration. Okay. Let's see what trades would have matched that 1 month out search, William, we just put in for the bull put credit spreads. Okay. Something strange is there. No, you guys are still seeing it. That's good. That's good. Okay. I'm showing a red line on the audience view. Now, the search results haven't come up yet. Now it's thinking, and now maybe Maybe the programmers had to make a change, so the history update was delayed. That explains a text message I just got. Actually, I don't check my phone during the webinars for this specific reason, ladies and gentlemen. That explains a text message. Okay, there we go. The top 15, William, of the 35 results, you've got Caesars, 25.4%, 75% probability, 10% of the money for October 16th expiration. Beyond Meat, Zillow, RH, Zoom Videos, Novavax, Sorrento, Sunrun, Vivint. Same criteria with a higher return, lower probability, but still a 10% range out of the money. No earnings between now and expiration, MACD crossover, as we'd use for the weeklies, but this is for a full month position. It's going to calculate the results for us. While it's calculating, okay, so it's running the first ones for us. It should already have grabbed it, but it's tabulating the numbers. This is the history issue. I think I want to do this again, October 16th. So let's go to October 19th. I don't think this will cause an error. I might cause one of these two to time out, trying to run two screens at once, the calculation and the search filter for October. So if I do, here we go. Not bad. 14 out of 15 were successful, going 1 month out. Average of a 16% return. Okay, but remember, I would probably only take the top 3 or 4, but remember, on the 2-week out one, we saw 8 out of 8, and from October 26th to November 6th, I know it's a different month, we're going to show that in a minute, we would have seen the 8 out of 8 and about 11 out of 11 from October 26th to November 6th, and then from November 9th to today, we saw 8 out of 8, 100%, and the average return was around the same, but we had done that twice with the top 3 or 4 trades. The average return is about the same. And that's, of course, assuming this one here, VSLR, got away from you. Now, to today's expiration, what's this search? Same thing, the monthly, October 19th, Monday following expiration. For the next standard expiration here, DocuSign, Adobe, KB, Ulta, Workday. I always want to say Workaday, but it's just Workday. Lennar, Bed Bath & Beyond. Now let's calculate the group results there, okay? So we had one outlier here with VSLR. Oh, this one's good. Okay, there you go. 15 out of 15 with 20.8% return for 30 days. So if you'd taken the top 3 or 4, okay, that's a higher average, isn't it? 24, 20. Let's call it, yeah, let's call it 25. A 25.8, a 24.1, a 25, and a 25. Okay, so on October, I know my numbers were a little bit different there, my time frame. On October 19th, you opened 4 trades for November 20th expiration, the top 4, and all of them were successful at a 25% return. From 10/26 to November 6th, the top 3 or 4 positions we had in margin all expired worthless, and we had that 15.5% average return. And from November 9th to November 20th, we were able to do 2 more trades or 3 more trades with an average of about 16.5. Okay, so that's kind of interesting, is it? We had less return, but we were able to do twice as many trades in the same time period as well. Does that mean less return total? No, it means we're doing kind of what we want to do. What is the one rule, that one basic rule about options? One of the many basic rules, but the one basic rule is when you're selling, you want to be selling closer in time if it makes sense, week by week or every 2 weeks, to get a higher annualized return. Okay? You didn't double my return going out 1 month. It wasn't 30%, in which case we'd have a good argument. It was 25.5 for these top 4 trades in this cycle, okay? And it was about the same on the last cycle. But I had done 4 cycles during each cycle you did. I had 2 cycles. So I had 4 cycles total for year 2, going 2 weeks out, and getting a higher annualized return because you're not doubling my average return. But this is a very short window, I understand. We just look from September to October, and then from October to November. It's a very short window. But this is very similar, by the way, to the testing that we did. Once, am I in the main search? Oh, let's just go back to the main search here. Okay. once I started finding the criteria that I wanted, that showed me the best historical results over time for success rate with the 1 week, 2 week, or 3 week, we started comparing it now to what if it was 1 month or 2 months out? Do we perform better? And the answer is no. You still perform well. You didn't perform better. The direct answer to your question is yes. Use the same criteria, double the minimum return going further out. You're not going to double necessarily the annualized return I'm seeing. In other words, your 1 month out or 5 week out trades might not be double the return. Just like my 2 week out trades are not double the return of the 1 week out. But what we saw in all of our testing is that even though you expect a higher annualized return selling week by week by week, and that's what we would logically expect with covered calls, with naked puts, with bull puts, those other strategies as well. Performance-wise, it did not reflect that because the losses wiped out more than twice as many of the trades, and now it took you longer to get back to break even. That was the problem. What's one of the better issues with doing this as well? Even though it's longer out in time, we're not getting a higher annualized return. You are getting double the credit or close to double the credit. What does that mean? You got sort of a better break even, don't you? Okay, you can take a loss, and if you control the loss on the bull put to what you should do to only be 50%, well, your 50% loss is a much lower value now because you're taking in more net credit. You're wiping out less trades, but you're sitting on it for 28, 41 days or so, William. So it's a little bit longer, but you see what you can do here. You can play with the probability because you can go further out of the money with a lower probability as you go further out in time. That slope sort of diminishes a little bit, related back to Roger's question about probability earlier as well. Okay, so I don't have, I have a lot of detail on this, but I don't have a lot of great visuals to show here. So Chuck's follow-up question to William, not really, is Chuck's follow-up question to me. Can you tell us more about this new product? Well, the new product is about 5.5 to 6 hours of video discussion. So unfortunately for you guys, the bull put credit spread product is going to be about 6.5 hours in various segments, 6 to 6.5 hours in various segments of my voice. So you're going to have to put up with that. But it's broken into various sections. It is not published yet, of course. I still have some finalizing to do with a couple more modules of Section 5 and one for Section 6, which is just a wrap-up as well. And that's what it's going to be. I don't know the price yet. You know that. I don't set the premiums. I don't set the prices for the products. It's going to have a final review, and it will be available soon. It's going to be more of a video product, but what are you going to see in it? Well, you're going to see the discussions, of course, of the basics for anyone new of what is a bull put credit spread, what are the goals. You're going to see the discussions on what we found with our testing, the results that we found and what we looked at going forward. You're going to see not only what our expectations are, of course, but what we saw. We're going to talk about the time frames I told you about of when and when not to trade these positions. We're going to talk about, well, it's already talked about, it's already recorded, it's just not available yet, Chuck. We're going to talk about the triggers one might use that you've heard me talk about loosely before. We're going to go into that too, about when one should consider to adjust or close these bull put spreads. When you first should start thinking about, hey, now is the time that this is not doing what I want. What are my options? We're also going to discuss what are the options, what are the management techniques, and are the management techniques really worth it in some situations? And are there other situations where you should just go away? All right. So all of these thoughts that you've heard me discuss on the various webinars over the last year or so, 6 months, and even some of the recorded ones that we have there where we've touched upon all of these ideas. Essentially what we're talking about with the bull put credit spread course is my entire thoughts, analysis, testing, trading, Ernie's thoughts as well into how we approach this bull put credit spread approach and what we're looking to achieve, how we do it, when we do it, why we do it, and so forth. So in a lot of sense, it's a lot like Ernie's covered call course. It's a full course on bull put credit spreads, not just what to look for and what it is that's going to help someone who's never heard of it before but wants to get into spread trading, especially if they feel the market's going to be bullish consistently as well, but also the in-depth aspects of What is the approach? What are the goals? What can you do? William brought up a good point. Doesn't mean you have to trade it the way that I trade it. There are ways that you can trade it going further out in time. What might you look for if you do go further out of time or closer in? What are some of the things you should consider? So it's essentially our entire thoughts on the bull put credit spread approach and our trading approach for bull put credit spreads, Chuck. That's what it is. That's what's going to be available very, very soon. Okay. All right. Okay. And Chuck says, sounds great. The sequel will be Bear Call Credit Spreads. Put me down for both. Yeah, I think Ernie wants me to do a different one next. I've been working on one on the side too as well that'll come out at the very beginning of 2021 as well. You guys have heard me talk about that before too. But then, yes, I think there's some another product Ernie wants me to put out. But then, yes, naturally, the next step is the Bear Call Credit Spread. Then probably going into bird's eye view of the last 3 years of iron condors, which I haven't been a fan of, honestly, over the last 3 years. They've been very difficult to trade and manage, and it's even with staying with just the indexes and just the ETFs, it's been difficult. You know why? You could just look at the SPY chart, QQQ chart over the last 3 years. And you can see why iron condors were fairly difficult. You always ended up managing one side or the other more than 65% of the time. It was very hectic trading those positions, trying to trade those iron condors the last 3 or 4 years. And just looking at any chart of any broad-based index or ETF, you can see why. All right. Okay. Ernie would probably want me to do this anyway, so I'm going to go ahead and do it. There we go. Pause the screen here. All right, so you're not seeing what I'm seeing right now. Just give me 1 second here. All right. So many of you are familiar with, some of you are familiar with our third-party service. We use learn.powerop.com, where you can get the electronic version of the blueprint, the other radioactive trading techniques, the covered call course I mentioned as well. Okay, so essentially this is going to be an electronic version that I mentioned to you, but it's going to be all video format as well. And so what I'm doing here is I'm going into admin, and because it's not published, of course. All right, and there we go, curriculum. So I also have to put in some other fun stuff into this as well. Okay, so I'm just going to give you a quick preview. Not really a preview, but just a curriculum preview. Okay, here's what we have so far. There we go. Okay, so it's all going to be in video format, addressing the curriculum. The first is just a basic welcome. Next section, first steps to start trading bull put credit spreads. And what we talk about there is, hey, what do you need to do? First, well, you need to apply to trade spreads. You need to, make sure you're approved to trade margin. You need to make sure you have these other things here as well. The full module 1 is just the bull put credit spread. The whys behind the strategy, risks and obligations, proper expectations, allocation, criteria, possibilities, the proper allocation for trading the bull put credit spreads, brief intermission, criteria. Okay, we go over what William sort of asked for, but this is almost 45 minutes long, if I'm not mistaken, going through the intense criteria, what worked, what didn't work as well. What is possible? Module 4, the anatomy of the trade. Planning to enter the bull put credit spread. What do you look for when you're researching and analyzing the position? Researching the trade, setting up the big charts, placing the trade with your broker, shooting for the midpoint. What happens if the midpoint doesn't get filled, and what to expect once you're into the trade. How do we expect the decay to work? How do we expect the movement of the options to work? That's that other part, module 4. Here we are in module 5, trigger points, management for recovery. In other words, your put was threatened, discussed in the trigger points when we consider managing it, but we expect the stock to go back up. What might we do then? We expect it to continue to go down. What might we expect to do then? The other module coming in is, what if we're not sure, or we expect it to stagnate? What management techniques might I could do? And what are wrong management? What are things you should not do when the bull put credit spread starts to go against you as well? And then module 6 is going to be a wrap-up, review, and next steps. So that's the curriculum that's coming out. 1 or 2 sections left in module 5. Oops, sorry, don't want you to see the admin there. And then I have to put in some pretty pictures and images to make that curriculum look attractive as well, and also some other pages to it too. So you see where we are right now. You see where basically I just have left to go. That's what I'm trying to do, and I'll probably get this done. I wanted to get it done actually last week. We had a lot of coaching sessions and a lot of discussions in that case, but this week I got a chance to work on it, and next week, of course, with the short trading week, we're going to get a lot of time to work on it. So it should be done next week, and I would look to see that December, if not sooner, the first announcement of when that is available as well. Working title that I'm probably keeping, unless Ernie tells me not to, is Taking the Bull Out of Bull Put Credit Spreads. Doesn't mean that we're taking bull put credit spreads and creating it for a bearish market. It just means we're taking all of the adverse ideas that are thrown out there so that we can get a nice, narrow scope of what works for us, what doesn't, what can work for you, and what doesn't. That's what the bull put credit spread product is going to be. Kip says it looks great. Thank you, Kip. Of course, as always, we'll let you all know when the full product is available as well.